Welcome to Ind AS Lab, a laboratory on Indian accounting standards. Let's try to understand the notification by Ministry of Corporate Affairs for companies Indian Accounting Standard Rules 2015. This notification, as you can see, is issued by the Corporate Karya Mantralaya Adhisuchana as dated 16th February 2015. This is the Hindi version of the notification, and here is the English version of this notification. We have tried to simplify this notification, because if you try to see this notification, here is rule 1, then we have rule 2, then it goes down with rule 3, rule 4, and then finally rule 5 of exemptions. This notification has an annexure, and these annexures include various Indian accounting standards. As you can see, the part B includes Indian accounting standards. For example, Ind AS 101, maybe I can show you one more Ind AS. Like here, after completing Ind AS 101, we have Ind AS 102, so on and so forth. That is from Ind AS 101 to Ind AS 114, and then from Ind AS 1 to Ind AS 40. Coming back here, as we can see, this particular notification was issued on 16th February 2015, and we have tried to simplify the way this notification has been written. Let's read it thoroughly. In exercise of the powers conferred by Section 133, read with Section 469 of the Companies Act 2013 and subsection 1 of Section 210A of Companies Act 1956, the central government, in consultation with NACAS, that is National Advisory Committee on Accounting Standards, hereby makes the following rules, namely, as we have seen, these are 1, 2, 3, 4, 5 different rules. That is 1, 2, then we have 3, 4, and lastly 5th, exemptions with the annexures. So let's come back to the first rule. As you can see here, the first rule is of short title and commencement, and let's try to read it from our summary. Short title and commencement. These rules may be called as Companies Indian Accounting Standard Rules 2015, and they shall come into force on the first day of April 2015. Let's read through definitions. Accounting standards. Accounting standards mean the standards of accounting or any addendum thereto for companies or class of companies as specified in Rule 3. So companies or class of companies are discussed in Rule 3. Let's have a quick look here. As you can see, the third rule. So as you can see here, these are some of the companies which have been offered under Rule 3 and Rule 4. Rather, Rule 3 navigates you to Rule 4, and we are going to see how that navigation happens. So Rule 3 states that you are going to apply certain rules which are specified in Rule 4 here, and that's how you get the navigation. The applicability of Indian accounting standard is to those companies, that companies are specified in Rule 4. So Act. Act means the Companies Act 2013. Annexure. In relation to these rules means the annexure containing Indian accounting standards appended to these rules. So we have just seen that here after rule 5 there is annexure. So annexure means this annexure which is amended to these rules and which contains Indian accounting standards. Entity. Entity means a company as defined in clause 20 of section 2 of the Act, and Act means Companies Act 2013. Financial statements means financial statements as defined in clause 40 of section 2 of the Act, and net worth shall have the meaning assigned to it in clause 57 of section 2 of the Act. So I am not going deep into what is the clause 57, what is clause 40, or what are clause 20s, because this is something which comes from the Companies Act, and here my primary aim is to simplify this notification and not to explain the Companies Act. So let's move down and let's try to read through it. As you can see, these are the definitions: Accounting Standard Act, annexure, entity, financial statements, and net worth. Words and expressions used herein and not defined in these rules but defined in the Act shall have the same meaning respectively assigned to them in the Act. So if at all we are going to use any particular word which is not defined in this particular notification, but if it is defined in Companies Act, then we are going to use that particular meaning from the Companies Act 2013. Let's try to now see Rule 3, applicability of Indian accounting standards. Let's do one thing. Let's quickly read through the text and let's try to see how the way we can sort of simplify that particular text. The accounting standards as specified in annexure to these rules to be called Indian accounting standards shall be the accounting standards applicable to the classes of companies specified in Rule 4. The accounting standards specified in annexure to Companies Accounting Standard Rules 2006 shall be the accounting standards applicable to companies other than classes of companies specified in Rule 4. So there is an annexure to Companies Accounting Standard Rules 2006. Like the name of this rule is Companies Accounting Standard Rules 2015. Similarly, we had Companies Accounting Standard Rules 2006. So here we have 2015 rules, but we also previously had rules which are 2006 rules. Now these rules includes standards which are existing standards. However, 2015 rules now include new standard which are Indian accounting standards. So this particular second point says that the previous standards are applicable to all those companies which are other than classes of companies which are specified in Rule 4. Companies which follows Indian accounting standards specified in annexure to these rules in accordance with the provisions of Rule 4 shall follow such standards only. That's what it says. You can't follow any other standard. You have to follow this standard. Hence it becomes mandatory requirement. A company which follows accounting standards specified in annexure to Companies Accounting Standard Rules 2006 shall apply with such standards only and not the standards specified in annexures to these rules. So it says that either you apply 2006 rules or you apply 2015 rules. If you are applying 2006 rules, you can't apply 2015 rules and the standards from 2015 rules. If you are applying 2015 rules, you must apply those standards, like the standards appended to this particular annexures. So let's try to quickly understand it. So the first pointer says that the name of the standard is Indian Accounting Standard. As far as the applicability is considered, it is applicable to all the classes of companies which are stated in Rule 4. So within a very short span of time, we are going to read through Rule 4 and going to understand exactly which companies are included here. And then it says that, okay, fine, if it is not applicable, if you are not from the classes of companies which are mentioned in Rule 4, then yes, it's not applicable. In that case, what are you going to do? Then you are going to apply those standards which are from Rule 2006. Now, you follow Indian Accounting Standard Acts in companies accounting standards rules 2006, which means that instead of calling it as an Ind AS, we used to call these standards as just accounting standards. So you follow previous or existing accounting standards. It also says that if you are other than companies covered in rule 4, then you must follow these existing accounting standards, and you must follow only those standards. Point number 3 says that you must not follow any other standard than Ind AS if you are in these rule 4 classes. So the moment you are from the rule 4 classes of companies, then you must follow Indian accounting standards. However, if you are not in rule 4, then you must follow Indian accounting standards, and you should not follow Indian accounting standards from this particular annexure which is appended to this notification. Let's move on to understand now rule 4, obligation to comply with Indian accounting standard. Again, we can come back here and try reading it the way they have offered us text, which is little confusing. So maybe we can read through this. It says that the companies and their auditors. See, it doesn't say that a company shall comply, it says companies and their auditors. So this notification is not only applicable to company but also to its auditor. And the word which has been used is not may comply, but it says that it shall comply with the Indian accounting standards specified in annexure to these rules in preparation of their financial statements and audit. So for preparation of financial statements, it's applicable to the company, and for audit, it is applicable to the auditor in the following manner, namely. Now the way they have written all these things looks very confusing, so I have tried simplifying it. Maybe this is a text format which we can use for our own facilitation, as I can highlight once again, companies and their auditors shall comply with Indian accounting standards Ind AS as specified in the annexure to these rules in what? 1. Preparation of their financial statements and audit, and here the word respectively has been used, which is very important, which means that for company you have to apply for the preparation of their financial statements. For auditors, we are going to apply it for the audit purpose. Right. Any company may comply. Now that's the difference. The initial word which has been used here is shall, and then now we have here may. So maybe for this one pointer, the voluntary adoption is allowed. But you can see 2, then you can see here shall. Similarly, in the Roman 3 here you are going to see shall, right? So in the Roman 1 we have may, which says that it's not compulsory, okay, and it's not compulsory from which date? It's not compulsory on or after 1st April 2015, but it becomes compulsory. The following companies shall comply with the Indian accounting standards on or after 1st April 2016, and then here comes on or after 1st April 2017. So here we have sort of the 0 phase, then you can say the first phase companies, and then you can say second phase companies, and whatever things have been written here, as you can see specifically here under the phase 1, on or after 1st April 2016 ABC, and on or after 1st April 2017 A, B, and again C. You need a different level of understanding. You need to read through each and every line, commas, semicolons, and referencing back referencing is absolutely required in order to thoroughly understand these provisions. And by the way, this rule is a key. This is the most critical rule which we are going to read. So let's come back here and then try to understand exactly which companies have to follow this Indian accounting standards. So it's an obligation to comply with Indian accounting standards. Now, obligation to comply by whom? Of course, by companies and their auditors. What is the obligation? Ind AS provided in the annexure to this notification. As I said, there are Ind AS from Ind AS 101 to Ind AS 114, and then we have Ind AS 1 to Ind AS 40. Now how are you going to comply? And this is the phase, as you can see. Now phase, as I said, phase 0, phase 1 and phase 2. Phase 0 is not a mandatory, it's a voluntary phase. Phase 1 and phase 2 are mandatory phases. So let's try to understand now the beginning, the adoption date. If we are speaking here about the day phase 0, which is a voluntary phase, it's from 1st April 2015, right? Let's read through that. Any company may comply with Indian accounting standards for financial statements for accounting periods beginning on or after 1st April 2015 with the comparatives for the periods ending on 31st March 2015 or thereafter. So now what happens that for 1st April 2015 opening balance sheet, you need, sorry, not the opening balance sheet, in order to adopt Ind AS from 1st April 2015, you need the comparative of 31st March 2015. And to create annual comparative of 31st March 2015, your date of transition is 1st April 2014. And which companies can voluntarily adopt Ind AS? It says that any company can adopt voluntarily. So, you may be net worth more than 500 crores or you may be a small company. If you are a company under Companies Act 2013, then yes, under phase 0, which is a voluntary phase, you could have had adopted Ind AS voluntarily. Now let's speak about phase 1 and let's try to see the way they have confusingly written all these lines. So let's come back here. The following companies shall comply with Indian accounting standards for the accounting periods beginning on or after 1st April 2016. So as you can see here, the adoption date, by the way, there is a difference between adoption date and transition date. So please make a note of this. Adoption date for phase 1 companies is 1st April 2016. And here you have the companies. Now A, B and C, they are going to explain you which are the companies which are included. As you can see, the companies, then again the B starts with companies, right? And again it says that 1, 2, 3, 4, 5 different companies covered in A or B, etc. So let's try to read through A, B and C of Rule 4, Clause Roman 2, Subclause A and B and C. Let's read it. So companies whose equity or debt securities, understand that it's not just equity, it says equity or debt securities which are listed or in the process of being listed on any stock exchange in India or outside India. By the way, it must not be just National Stock Exchange or Bombay Stock Exchange. It can be any stock exchange in India or outside India. And now this parallelism rule is important. And having net worth of rupees 500 crores or more. This is something included in A. B, companies other than those which are covered by subclause A. So subclause A is this. Of clause Roman 2. So this is a Roman 2. Of subrule 1 and having net worth of rupees 500 crore or more. So if you are having net worth of 500 crore or more, you are included here. So let's try to simplify this. Now which companies are included here? See, if you are having either equity or debt security which is listed or in the process of listing on any stock exchange, plus if your net worth is more than 500 crores, then you definitely come under phase 1. Equally, let's say if you are not covered in A, because let's say you are not listed, but your net worth is more than 500 crores, even in that case you still fall here, right? So in short, if your net worth is more than 500 crores, say the company is Peace Limited, then yes, you fall under phase 1, right? So let's do one thing. We have created amazingly great chart to explain the concept of phase 1, because there is a concept of the companies where the Ind AS is applicable, and there is a concept of companies to which Ind AS is not mandatorily applicable but needs to be computed, needs to be created in order for the consolidation purpose of a company which falls under phase 1. So we have here C, which says that holding, subsidiary, joint venture or an associate of companies covered in subclause A, of clause, the subclause A is this, and subclause B, so subclause B is this. So holding, subsidiary, joint ventures and associates of companies covered in A and B, A or B, they are also covered under phase 1, and this is little challenging. See, understanding this C is little challenging, so maybe we will take the help of chart to understand this. Let's go back to our simplified version. For the purpose of chart, the main company is Peace Limited, and then the Peace company will have H2, that is a holding company of Peace. You can call it as a parent, but I'm not going to call it as a parent, because rather parent is an Ind AS word. I'm not going to call it as a parent because this wording doesn't say it's parent, it says that it's holding. So then the next question is, what do you mean by holding? Holding as per the previous accounting standard, or holding means a parent under Indian accounting standard? So that can be another area of deliberation, but let's not go into that complexity. Let's try to just focus on the way we have to create the chart for our own understanding. So H2 is holding company of Peace Limited, H1 is a holding company of H1 Limited, S1 is a subsidiary of Peace Limited, so on and so forth. This is the coding, and you can easily understand it. It's just a summary of that coding. Just make sure that you understand Peace Limited is our company and we are thinking it from Peace Limited's perspective. So as you can see here, Peace Limited is our company. Let's try to see the abbreviations first. FTC-Ind AS means fit to consolidation for Ind AS purpose. Ind AS means Ind AS is applicable. AS means IGAAP is applicable. That's Indian generally accepted accounting principle, or maybe existing standards. When I have sort of eliminated, I have sort of used this line by crossing AS, then it means that the IGAAP is not applicable. And when I use this cross, red cross, it means Ind AS is not applicable. And when I use the green correct sign, which means that yes, Ind AS is applicable. So for Peace Limited, what happens is that, let's assume that the Peace Limited falls under either A or B, right? Let's say Peace Limited falls under the company whose equity or debt securities which are listed and the net worth is, let's say, more than 500 crores. So what happens now? The question is, if for Peace Limited Ind AS is applicable, then whether for H2 whether the Ind AS is applicable or not. Now here, if you categorically read, the holding of company covered in subclause A also falls under this rule, where it has obligation to comply with Indian accounting standard. So definitely yes, H2 is also covered, but not under Roman 1. H2 is not covered under this Roman 2A. H2 is covered under Roman 2C. So H2 may not be listed company. H2 may not be having net worth of more than 500 crores, but because Peace Limited is under A, holding company of Peace Limited falls under C, and yes, to this H2 company there is obligation to comply with Indian accounting standards. Coming back here, H1 is holding company of H2. Now H1 may not be again a listed company, or let's say may not be having a net worth of more than 500 crores. So the question is whether Ind AS is applicable. Yes, because here the holding means the ultimate holding as well. So here in our scenario, H2 may be the holding company of Peace Limited, but H1 is the ultimate holding. So yes, even for H1, Ind AS is applicable and there is an obligation to comply with Ind AS. But now again, H1 comes not from A, H1 comes from C. So here it comes from 4 Roman 2 C and not from 4 Roman 2 A. Under the significance, why am I repeating this Roman 2 A versus Roman 2 C? There is absolutely detailed significance of it, which I am going to elaborate in just 2 minutes. Now the next question is, let's say if H2 has a subsidiary, H2 has a joint venture, H2 has an associate. Question is whether to H2S1, H2JV1 and H2A1 Ind AS is applicable or not. Now understand that H2S1 doesn't fall in C because it is not the subsidiary of company covered in A. It is not the joint venture of company covered in A. It is not an associate of company covered in A, but it is subsidiary or joint venture or associate company covered in C itself. Understand that here H2 is covered under the obligatory requirement of Ind AS compliant, not under A but under C, and C covers holding subsidiary joint venture associates of companies covered in A, not of holding subsidiary joint ventures and associates of companies covered in C. Can you see here C, subclause C? No, it's only subclause A which is covered. Hence, H2S1, H2JV1, H2A1 do not fall under subclause C, and to these companies, yes, Ind AS is not mandatorily applicable. However, to create because to H2 it has become mandatorily applicable for H2S1, H2JB1 and H2A1, they need to create fit for consolidation Ind AS financial statements so that they facilitate the creation of consolidated financial statements of H2. Similarly, H1S1, H1JB1, H1A1, which are subsidiary joint ventures and associates of H1, and H1 became H1 became a part of obligatory requirement as a part of subclause C, not as a part of subclause A. Rather, Peace Limited is the only company which is from subclause A. H1 comes from subclause C, and hence again for H1 it is obligation to comply with Ind AS, but for H1S1, H1JB1 and H1A1 it is not obligation to comply with Ind AS. Rather, they again need to create fit to consolidated financial statements. Now, coming back, as you can see in this notification, as we have seen this rule 3, it stated that if this is a company which is not from this rule 4, so for all other companies which are not, see, as you can see that companies other than the classes of companies specified in rule 4. So in our scenario, all those companies which are not either A or B or C, to them rules 2006 are applicable, and hence they must comply existing accounting standards. As you can see here, they must comply existing accounting standard. So their legal books of account, their statutory books of accounts will remain existing accounting standard. However, they need to create financial statements which are fit for the consolidation, because for H1, H2 and Peace Limited, Ind AS are their statutory books of accounts. Right? Now let's try to see what happens in case of S1. Now see, S1 is what? S1 is a subsidiary of Peace Limited. JV1 is a joint venture of Peace Limited, and A1 is again associate of Peace Limited. So according to our analysis, subsidiary, joint venture and associate of Peace Limited forms a part of obligatory requirement as a part of clause C, but subsidiary of S1, joint venture of S1, associate of S1 needs a separate assessment. Now subsidiary of a subsidiary also forms a part of obligatory requirement, and yes, it must follow Ind AS, as its statutory books, no doubt about it. However, for joint venture of subsidiary and associate of subsidiary, you must follow existing accounting standard, because you are not a company which forms a part as maybe a subclause C or maybe a subclause A. So for all those companies, as you can see here, whether the subsidiary of a joint venture or a joint venture of a joint venture or an associate of a joint venture, or maybe a subsidiary of an associate, joint venture of an associate or associate of an associate, Ind AS is not applicable. It's the existing standard which remains applicable. However, for the purpose of consolidation, fit to consolidated financial statements may be required to be prepared. For joint venture of a Peace Limited or an associate of Peace Limited, Ind AS becomes their mandatory books. That's a statutory book. Now coming back here, the phase 2 is more or less similar as far as this part C is considered, just that the adoption date is 1st April 2017 instead of 1st April 2016, and hence the comparatives of 31st March 2017 will be required, for which transition date becomes 1st April 2016. Now, company to which phase 2 is applicable are again all listed companies, first of all, having a net worth of less than 500 crores. So I will say that listed companies having net worth more than 500 crores are getting covered in phase 1, and rest all companies are getting covered in phase 2. So in short, for all those companies where the equity or debenture, debt security are listed or in the process of listing, they are getting covered either in phase 1 or in phase 2. All other companies, so in short, which are not listed companies with net worth which is in between 500, which is less than 500 crores but which is greater than or equal to 250 crores, then again these companies are included here. And if you read the C part, right, as you can see here, so by the way, here again we are speaking about the second phase. If you see the C part, it is exactly similar to whatever we had discussed, which is similar to the chart what we have seen in our previous discussion. However, now the area of discussion is, if at all we are speaking about stock exchanges, what if these companies are in the process of, or they are listed in, let's say, a small or medium stock exchanges. So provided that nothing in this sub rule except clause 1 shall apply to companies whose securities are listed or in the process of being listed on SME exchanges as referred to in chapter XB, or on the institutional trading platform without initial public offering in accordance with provisions of chapter XC, 10C of XC of Securities and Exchange Board of India, that is SEBI, Issue of Capital and Disclosure Requirements Regulations 2009. So explanation 1, there are some 5 odd explanations, so let's read through each explanation. Alright, and let's try to maybe use our simplified version of explanations. Explanation 1, SME exchange shall have the same meaning as assigned in chapter XB of Security Exchange Board of India Regulation 2009, and comparative shall mean comparative figures for the preceding accounting period. So explanation 2 was about comparatives, and it was for preceding, of course, accounting period. 2, for the purpose of a calculation of net worth of companies under sub rule 1, the following principles shall apply, namely the net worth shall be calculated. So in short, here we are speaking about calculation of net worth. So the net worth shall be calculated in accordance with stand-alone financial statements of the company as on 31st March 2014, or the first audited financial statements for accounting period which ends after that date, the first audited. So let's say that you have never audited that company previously, but the first audited financial statement ends on, let's say, 30th April instead of 31st March, then you will compute net worth as of 30th April 2014 instead of 31st March 2014. In all other cases, you must be computing this net worth as of 31st March 2014. For companies which are not in existence as of 31st March 2014, or an existing company falling under any of thresholds specified in sub rule 1 for the first time, that is first time after 31st March 2014. So what happens that as of 31st March 2014, let's say your net worth was less than 500 crores, but it became more than 500 crores after 31st March 2014. So what to do? Then it says that net worth shall be calculated on the basis of the first audited financial statements, by the way, first audited financial statements ending after that date, in respect of which it meets the threshold specified in sub rule 1. So let's say that as of your 31st March 2014 balance sheet, your net worth was less than 500 crores, but it became more than 500 crores. So now the first audited financial statement will be of 31st March 2015 for that company, and hence you are going to compute the net worth as of 31st March 2015. Now there is a ITFG Clarification Bulletin 1, issue 1, which said that, let's take the example, company X on the standalone basis had a net worth of above rupees 250 crores but below 500 crores in financial year 2013-14 as well as for 14-15, and is expected to exceed rupees 500 crores in 15-16. Whether the company X required to comply with Ind AS from financial year 17-18, that is under phase 2. Given that the net worth, so here we are speaking about, by the way, the application of phase 2, and this is not a listed company, it's just that the net worth is between 250 to 500 crores. Given that the net worth as on 31st March 2014 was below 500 crores and the company X was a company existing as on 31st March 2014. So, for companies which are not in existence, you are going to apply, this B section. Now, because the company was existence, you will apply here A section, and the A section says that the standalone financial statements net worth compute as of 31st March 2014, or the first audited financial statements for accounting period which ends after that date. Let's see now the clarification. So it was existing company as on 31st March 2014 and was already falling under the threshold as of 31st March 2014 itself, irrespective of the fact that the net worth as on 31st March 2016 might be above rupees 500 crores. Response: Rule 4.2 of Companies Indian Accounting Standard Rules 2015 states as under. So it's the same rule which has been stated, and as you can see, A, B and C here. Explanation is more important to us. So let's directly jump to the explanation. For the purpose of subclause B, the company is meeting the specified threshold given in subrule 1 for the first time at the end of accounting year shall apply Indian accounting standards from immediate next accounting year in the manner specified in subrule 1. In view of the requirement at B above, any company that meets the threshold as specified in rules in a particular financial year. So here the company that meets threshold as specified in the rules in a particular financial year, the company's Indian Accounting Standard Rules 2015 will become applicable to such company in immediately next financial year. Therefore, in the given case, company X which had net worth of above rupees 250 crore but below rupees 500 crore in the financial year 13-14 as well as in the year 2014-15 and is expected to exceed rupees 500 crores in year 2015-16 will have to prepare financial statements on the basis of Indian accounting standards from the financial year beginning on 1st April 2016. Now, to be very honest, ITFG clarification is not or may not be considered as mandatory in nature. According to my personal opinion, I also question the authenticity and interpretation issued by ITFG. So you have all right to question the bulletin which has been issued by ITFG, because the legal standing of ITFG cannot, or according to my understanding may not, overrule the interpretations which can be drawn from the notification itself, because ITFG notification comes as a part of ICAI attempt to offer guidance of interpreting a particular standard or a notification. However, the notification itself is a legal document. ITFG may not have the level of legal sanctity as a notification, and according to me, you can challenge the ITFG clarification. According to ITFG clarification, this particular company where the net worth is above 250 crores but below 500 crores, however expected to reach more than 500 crores in financial year 15-16, is expected to fall under phase 1, as you can see here, as they have asked to follow Indian accounting standard on beginning from 1st April 2016. But according to me, you have all right to question that. Let's move on. The illustration from the notification itself is that the company is meeting threshold for the first time. See, for the first time as on 31st March 2017 shall apply Ind AS for the financial year 17-18 onwards, that is from 1st April 2017 such companies must apply Ind AS. The company is meeting threshold for the first time as on 31st March 2018 shall apply Ind AS from the financial year 2018-19 onwards, that is from 1st April 2018 they should adopt with Ind AS. Let's move on. Standards in annexures to these rules, once required to be complied in accordance with these rules, shall apply to both standalone financial statements and consolidated financial statements. So this becomes very interesting, and it's very important point which says that you are going to apply it in standalone as well as consolidated financial statements. Companies to which Indian accounting standards are applicable as specified in these rules shall prepare it their first set of financial statements in accordance with Ind AS effective at the end of the first Indian accounting standard reporting period. So this particular point simply says that this will be your first set of financial statements in accordance with Ind AS. Explanation: for the removal of doubts, it is hereby clarified that the company is preparing financial statements applying the Indian accounting standard rules for the accounting period beginning on 1st April 2016 shall apply the Indian accounting standards effective for the financial year ending on 31st March 2017. So here, reading this fora and explanation together, what do we mean by this? This means that all those Indian accounting standards which are effective for the financial year ending on 31st March 2017 will become applicable for the period beginning on 1st April 2015. Now here is a twist. See, Ind AS 115 was previously notified, but now it has been withdrawn. Rather, Ind AS 11 and Ind AS 18 will be effective for the financial year ending 31st March 2017. So for the first set of financial statements in accordance with Ind AS, you will need to apply Ind AS 11 and Ind AS 18 instead of Ind AS 115. Let's talk about overseas subsidiaries, associates, joint ventures and other similar entities. So now we are dealing with overseas subsidiaries of an Indian company. So the parent company is Indian company, but subsidiary, associates, joint ventures or other such entities are overseas companies. Now they may prepare its standalone financial statements in accordance with requirements of specific jurisdiction. So what it says that these companies are excluded from the preparation of Ind AS financial statements. As you can see here, this particular point stated that once these rules become applicable and if you are a company following it, then yes, both standalone and consolidated financial statements must be prepared in accordance with Ind AS. However, this particular point says that standalone financial statements may not be prepared in accordance with Ind AS, but rather may be prepared in accordance with specific jurisdiction. So these companies are exempted from preparing these financial statements in accordance with Ind AS, provided that such Indian company shall prepare, which means that the parent Indian company shall prepare its consolidated financial statements in accordance with Ind AS, either voluntarily or mandatory if it meets the criteria in specified sub-rule 1. So if the parent company is preparing its consolidated financial statements as per Ind AS, then its overseas subsidiaries, associates and joint ventures or other such entities are exempted from applying Ind AS to their standalone financial statements. Rather, they can follow the specific jurisdiction requirements, that is the domestic or local requirements of that nation to prepare its standalone financial statements. Now, Indian company which is a subsidiary, associate or joint venture and other similar entities of a foreign company. So now in this case what has happened is the foreign company is a parent company and Indian company is a subsidiary company, shall prepare its financial statements in accordance with Ind AS, either voluntarily or mandatory if it meets the criteria in sub-rule 1 above. So basically, if the Ind AS is applicable to Indian company, despite the fact that it's a subsidiary or associate or joint venture or maybe some type of similar entity of a foreign company, doesn't mean that it is exempted from application of Ind AS. Because it falls in these rules, it must apply Ind AS. Now any company opting to apply Ind AS voluntarily, as you can see here, as specified in sub-rule 1 for its financial statements, shall prepare its financial statements as per Ind AS consistently. So that consistency is important even if you are going ahead with voluntary application. Once the Indian accounting standards are applied voluntarily, it shall be irrevocable and such companies shall not be required. Now see, it shall be irrevocable. That's important. So you can't go back and say that no, now I'm not going to apply it, rather voluntary adoption was wrong and let me come into the phase 2. So let's say if some company which is covered in phase 2 actually goes for a voluntary adoption in phase 0, then it can't roll back and say that no, for this particular period let me go back to accounting standard and then let me come back in a phase 2. This is not possible. This is not going to happen at all, right? Yeah. So just a second. So yeah, once you apply, let me just re-highlight consistently here, and yeah, once you apply voluntarily, then it shall be irrevocable. That's the key. And such company shall not be required to prepare another set of financial statements in accordance with rules 2006. That is, you are not required to apply old accounting standards, or you can call them as existing accounting standards. Once a company starts following Ind AS, either voluntarily or mandatory on the basis of criteria specified in sub-rule 1, it shall be required to follow Ind AS for all subsequent financial statements. Even if any of the criteria in this rule does not subsequently apply. So the application of criteria will be judged only once. Once applied, always applied. Now from this notification, the insurance companies and banking companies and non-banking financial companies are exempted. Right. So this was about a quick understanding of Ind AS and its applicability via this notification dated 16th February 2015. I hope you enjoyed this session. Make sure that you subscribe to our free content. That's very important, because you will be getting many updates, maybe each week, each month. We also have the facility of blog which will be coming up, and we also have a video content explaining all paragraphs of Indian accounting standards. So I strongly request you, I urge you to subscribe to our video channel, subscribe to our blogs. If you have queries, you can always ask us, ask an expert. A facility that is available at our website. But yes, always stay tuned to Ind AS Lab, because we are a research oriented organization.